All right, welcome back to Power Lunch. Worries about the economy have been hanging over the markets with this morning's weak read on consumer confidence adding to that. Plus, don't look now, but earnings season is just a couple of weeks away. Dryden Pence is Chief Investment Officer with Pence Capital Management. Dryden, welcome. Good to have you here.
Happy to be here.
How much more do you think the Fed will or needs to cut interest rates to make sure we don't, make sure we don't dip into a soft trough?
Well, now it's turned into a question about cuts to a question about cadence, right? So we're moving from cuts, what are the cadence? So now we've had the 50 basis points. We think there was probably 2 more this year, and then they'll probably spread it out over 2025 as they begin to kind of see and get the data in. So I think that's...
So you get rates ultimately that are 2 points lower than they are now. That puts them in the 3.25 range, and that's where you think a kind of equilibrium exists?
Equilibrium is probably about 3, but I think they're going to try to take their time getting there, because they've done a great job of breaking this inflation thing, bringing it more into level. And so you don't want to blow the soft landing by reigniting something. So I think that's kind of where it's like if playing gymnastics with data. They stuck the soft landing. So let's get the score and go on.
And you're looking at some. You've almost got both in your portfolio of the either-or fight that's going on in markets right now. Do you go with big tech and momentum and chips, or do you go small cap and kind of the broadening out? You've got AMD and the small caps, and you've got ASML. By the way, Intel had an ASML stake that maybe they should have hung on to. That's a separate story.
Very, very
why this approach?
Well, I think that the point is first of all, you're going to continue to have the mega caps do pretty darn well, but their earnings projections are a little less for next year. But when you look at the rest of the S&P 500, you're seeing a continued growth, that they're going to look at 13 or 14% on earnings growth. That's going to be a pretty good market for next year if you take a look at it. So I think this broadening out, I've talked about being part of the 493. So we trim down some of the Magnificent Seven, spread out to the 493. You begin to see small caps grow in this environment. Lower interest rates for companies that borrow is going to be accretive to earnings. So I think all of those things are coming together to have a broader diversified portfolio, a broader diversified set of earnings growth going forward. So 2025 begins to shape up as a pretty standardly good year.
So get on the 493. It sounds like driving directions in L.A. Get on the 493 to the 405 and whatever. So what about the 7? Should I take the 7 or not?
Well, if you take the 7, you're still going to get there pretty good, right? The 7 is going to be all right, because you're going to probably have about a 19% earnings growth. It's going to come down from 30 or 40. It's going to come down to 19, but you take the 7, you're doing all right.
It's like a New York subway line.
Yeah, take the 7.
Yeah, that's it. So it's all about transportation today.
Yes, it
so
is.
Which route do you take?
But I guess, is there any which way you see this kind of ending not so well? We've talked, it's pretty much consensus now, soft landing. We spoke with the retail analyst last hour. He says he's excited about a lot of the names in the sector after we get through the holiday period. I guess this is the all clear. You never want to say all clear, but I think the thing that you worry about is some large exogenous shock. You always have to, there is tail risk out there, and that would derail it. Otherwise, I think, more people are working than ever before. More people are making more money than ever before. Is that true?
Yeah. You've got 100. We've grown.
Just because the unemployment rate is up at the margin, I mean, there has to be some loosening.
But we added 6.1 million workers, right, in the last couple of years. That's like the entire labor force of Illinois. That's the equivalent. If you take it and multiply it out by salaries, we've added the entire economy of France in the last 4 years.
Wow.
So if you think about that much money, that many people, stimulating this economy, it really kind of gives us a good basis for looking at things going okay forward. Now, the softer part of the soft landing, right, the people making under $50,000 a year, those are the ones that were heavily affected by this consumer confidence number. But I think that when you look at it in total, we're set up for a pretty good basis, because, again, you've got a lot of people working, they're making money, they're spending it. That's what consumers do.
I don't know why the Fed cut rates then. Maybe they should have just said, we'll just go a quarter and,
Well, I think they felt that they maybe should have moved in July. And so we didn't move in July. Let's go ahead and get it 50, and then we can kind of be data dependent going out. So that's why I talk about it. It's all about cadence going forward. And the other thing is the Fed's far differently now than they were a couple of years ago. They've got bullets in the arsenal. They've got bullets in the gun. They've got the ability, if they have to make moves to lower interest rates, then they have the ability to do that. And I think that's really important.
Dryden, nice to see you again.
It's good to see you again.
Dryden Pence.
Appreciate it.